Hi there. In this video, we will talk about the consolidation of financial statements between a parent company, which is the acquirer, and a subsidiary company, which is the acquired company. And instead of building the presentation on a PowerPoint, I thought of making the presentation on Excel. And as you can see here, I'm going to work on 6 different examples that tackle all the key points that you need to be aware when you make the consolidation. And I hope you find the presentation is useful for you when you do the assignment of this week. In the first exercise, we see here a subsidiary company, which is the acquired company, has some accounts. And as you can see, the accounts are shown in the book value format and in the fair value. And the parent companies agreed to pay $3,460,000 cash and issue 29,100 shares of its $2 par value. And here you need to know that if you get the par value, $2, and the fair value of the share at that time, $50, we have to consider the difference between them and put it in the additional paid-in capital of the parent company. And all the subsidiary common stock here, after which the subsidiary will cease to exist as a separate entity. In addition, the parent company is going to pay $29,600 for stock issuance and $50,800 for legal fees. The first point that we need to know when we make this kind of consolidation is how to create the journal entry. Who is doing the journal entry? The parent company. Why? Because the subsidiary company is going to maintain its own books as is usually doing, but the parent is required to show the journal entry of the acquisition and create the consolidated financial statement from that moment on to show the movement of the parent and the subsidiary as one entity. So the first point we need to ask, when we make the journal entry, shall we take the book value figures or the fair value? The answer is the fair value. And if the account here shows up without parentheses, it means this is a debit account and you can tell that this is asset. If it shows in parentheses, it means it's either liability or owner's equity. And as you can see, all the accounts here are the subsidiary. So the parent company doesn't have any account here. So how do we start? We usually start by identifying the account. It's either debit or credit. So here you can see that the inventory is debit, land debit, buildings debit, customer relation, which is intangible asset, is debit, accounts payable is credit. And here we need to know that the parent company issued 29,100 shares at a par value of $2. So the amount that will go to the common stock is 58,200. And the difference between the fair value 50 and the book value 2, $48 multiplied by the number of shares, we get the additional paid-in capital account by $1,396,000, and then the cash payment $3,460,000. Based on that, we make the following journal, which I put it here. So here we debit inventory by the fair value, land, building, customer relation, as you saw them here by fair value. So I included them here. On the other hand, I put accounts payable, common stock, additional paid-in capital based on the calculation. You have seen it. And then the cash payment. How do we get the goodwill? The total amount of the credit is usually higher than the debit amounts, and the difference will go to goodwill. In the next exercise, you will see that the debits are higher than the credits, so the difference will fall in the credit side, and we call it gain on acquisition. So this is the first journal that you need to know. And here is the way we calculate it. Here we put the fair value, and here we put the fair value plus the cost of the shares, either at par or fair market value. And then for the professional services, here, 50,800, and the cost of issuing the stock, we put them in separate journal entries. So this is in brief how to make the journal entry of the acquisition by the parent company. I hope you find this video useful. And in the next video, I'm going to talk about the other examples. Thank you. Bye-bye.